If you sold a commercial property today, how confident are you that you could identify a replacement asset within 45 days or close within 180? And why is that question even important? With tax changes and rules and so forth, we're going to get into this topic today of 1031 exchanges. Welcome to CRE with CBC Worldwide, the podcast exploring the ideas, strategies, and trends shaping today's commercial real estate market. I'm your host of this series, Dan Spiegel, Senior Vice President at Coldwell Banker Commercial. And today we're diving into the cornerstone of investment strategy, the 1031 exchange, a tool that can significantly enhance returns, preserve capital, and shape long-term portfolio growth. To help us unpack the opportunities and nuances around 1031 exchanges, especially as we look ahead at potential changes following the 2025 Big Beautiful Tax Bill, I'm joined by Aaron Consavichus, VP of Business Development at 1031 Specialists. Aaron, welcome to the call.
Thank you very much, Dan. Glad to be here.
Aaron and his team focus exclusively on 1031 exchange advisory, working with investors nationwide to navigate timing, compliance, and strategic replacement planning. So whether you're a broker helping clients plan for dispositions or an investor evaluating your next move, this episode will leave you better informed and maybe even inspired to take your next step. So let's jump in. Aaron, before we get into the mechanics and all the nuances and technicalities of 1031s and whatnot, why don't you tell us a little bit about yourself, your path? How did you get into the world of 1031 exchanges? What experiences shaped your focus on helping investors leverage tax-efficient strategies? Anything else you want to share with the audience in terms of your career to this point and how you got there? And then we'll get into the details. So
Sure. Thank you. Yeah, no, I appreciate that. So my real estate journey really goes back over 25 years. And a lot of that was in finance, actually. And starting off in Northern California, where I'm from, and then a detour through Hawaii, where I was there for several years. And then the last 10, 11 years here in San Diego. But what happened here in San Diego was I ran across a local QI, an attorney that had been doing exchanges for over 20 years. But what he was wanting to do was set up a brokerage to be able to provide loans for his clients as they need replacement loans, right? So I came in and actually set up a loan brokerage right within his office. But the amazing, kind of synergy happened. We didn't realize what a perfect fit it was because now here I am. I know the backside inner workings of what escrow is actually doing, what underwriters are doing, what's going on with the process in and out. I know how to make things work, put strategies, deals together. So I started actually advising on the 1031 strategies at the same time and became the lead advisor. I've advised on deals anywhere from 100,000 to 100 million. And but one of the examples, or I guess scenarios that really caught my attention when I very first started, one of their best clients that had been with them for years, he was in the middle of a large apartment building complex. And the attorney told me his backstory. He said, well, he came to the country decades ago as I think a teenager with a few bucks in his pocket, got into a little bit of real estate, was good at it. And now here he is a few decades later, we're doing a $60 million exchange for him. And it really impressed upon me, wow, this is how, wealth is created using the 1031 exchange. At the same time, we looked at the numbers and we realized, if that's being the case, why isn't everybody doing exchanges? And we realized there's a large number of properties out there being sold that could be exchanged that aren't doing them. And so I really get out there and push on the education and the teaching front on that for brokerages, CPAs, attorneys, financial planners, and so forth. And I do that all across the country.
Yeah, excellent. So, we should not presume everyone knows what we're talking about. We jumped right
Sure.
in with all the lingo of the business, right? So
Right.
we should start out with 1031 is a provision or it's a section of the tax code, right? 1031, I think it's
Yes.
called. I don't recall when it exactly was enacted, so I won't get into
Sure.
that.
Yep.
But it allows people to essentially defer tax liability. So why don't let's just start with a level set. Let's start at the beginning.
Hmm.
Explain to people what is the 1031 and why is it beneficial in the examples that you just gave? Just start with the
Absolutely. Yep.
basics.
Yep. So it's exactly a provision in the tax code, section 1031, that allows investors when they're selling investment property. Normally, if we just sell property and report that, that's going to trigger a large tax bill. on the capital gains. And so the 1031 exchange allows an investor to make that sale and put it into another investment property or properties and defer that capital gains tax bill. It's been in the IRS code for over 100 years, and it's really how wealthy families have been passing generational wealth down through all the decades. So it's keeping the wealth and the equity compounding instead of setting that back, sometimes several $100,000 if that went to the IRS. And it can go to better performing properties. It can go to multiple properties. There's all sorts of uses that it can be, quite useful for.
Great. Now, just to be clear, is this something that institutional investors use, or is it something private investors should be concerned about? What segment of the investment marketplace should be cognizant of the 1031 capability?
Yeah, really, any investor needs to know about it. The institutional investors, ones that have large portfolios, that's exactly what they've been using to keep growing them. All the way down to the mom and pop investors that are, selling their first rental property and they've never heard of it. They need to know, because what's going to happen otherwise is they're going to make the sale, they're going to pocket their money, hopefully not spend it. And then the next year they have to report that sale on their tax return. And then that's when they're hit with the surprise. It can be, again, hundreds of thousands of dollars in some cases. And so they need to know about that at least, and then they can make wise decisions as to whether it's right for them. They want to do a partial exchange, or we can talk about some of those strategies.
Yeah. All right. So it's pretty much available to any investor in commercial real estate, right?
Hmm.
Frankly, in residential as well. If you're using it as an investment property, that's the key.
Right.
And I know, for listeners, like, I'm sure if you're a novice investor, you're super excited if you've invested in something, you have a gain, you're just like, yeah, I want to sell it and take the gain and run to Hawaii,
Right.
right? Or something like that.
Yep.
We were just talking about Hawaii with Aaron a moment ago. But in any case, there's an eagerness just to take the money and run, so to speak. But the real smart thing to do is to think about the 1031 exchange, and the ability, as Aaron was describing, to defer the tax liability on that. So why don't you talk a little bit more about the technicality of what does that mean? How does that work, right? So I have a property, I bought it for 2 million, I'm selling it for 4 million. Now what do I do? Or do I need to think about it prior to close? Help us
Yep.
through sort of the technical steps
Yeah,
here.
let me go through how that's done. So the IRS, in order to accomplish that 1031 exchange, requires what's called a qualified intermediary, or QI, or a facilitator that's going to handle the exchange. So that's what we do. What that entails is, first, just the process of it. Once somebody is under contract selling their property, we're going to collect all the information from title. We're going to collect the information from the investor. We're going to set up the exchange documents correctly that the IRS needs. We're going to give the instructions to the closing agent, to title, so that we're listed properly on the settlement statement and so forth. The other big part of it is then those funds, when the property closes, are going to be sent to the qualified intermediary, to us, to be held safely, because that investor cannot touch those funds or they're going to get taxed. And then when they're ready to close on the replacement property or properties, we're able to get authorization to forward those funds to close on that. As far as the starting point, it does have to be set up before the close of the sale property. Otherwise, they have no chance of completing an exchange, even though the exchange period is
Okay.
180 days. People see that, and we can get into more on that. But it does have to be set up before that closes. As far as when they should be planning for it, so I tell brokers all the time that as soon as they're talking with an investor, even about an inkling of selling, the conversation needs to at least be started. There's a number of reasons for that. There's different rules. There's some nuances. There could be title questions. Maybe some of their strategy, which they're thinking in their mind, we need to go over and make sure it's matching up actually with what the IRS says they need to do to get the full tax deferral. And so if they wait until the last minute, right before they close their sale, which, on our end, that's fine. We can set up the paperwork and handle that. But oftentimes, if they had some misconceptions, some things they weren't thinking right about, now it's too late for them to kind of change course a little bit. So it's far better just to have us consult. We can talk to them for a few minutes, even if it's months and months before they even list their property. It just gets them set on the right course, and then we set it all up once they're in contract.
All right. So if I understood, let me just think the key takeaways there is one is don't wait till you've closed and go, okay, I want to 1031 it now into something else.
Please
I think
don't.
your key takeaway was you need to plan for it in advance.
Yes.
Preferably not the day before, but something more in advance because you can't just sell and then make the decision. You have to actually plan for it because the proceeds have to pay into the QI, as you called it, the qualified intermediary, right? So
Correct.
that's a key step there. Don't wait till the sale's done and then decide to do it. Now, is this ability equally available to an individual investor as a individual taxpayer as it is for an LLC or corporation? Because people can set up investments in a variety of legal statuses. Is the tax code beneficial treatment available to a variety of tax statuses?
Absolutely, and that's the great part about it. So the IRS will call it, continuity of taxpayer. What that's saying is whoever the taxpayer is that's selling needs to be the same taxpayer that's buying. So whether it's in the personal name or an LLC or a corporation, it needs to stay the same. There are times where perhaps like a single investor might set up an LLC to hold the property. It might be what's called a disregarded LLC, meaning the person's still the taxpayer, right? So they can still set that up either way, as long as that person is still the one doing the exchange.
Got it. Okay. So I should by also say here, neither Aaron or I are giving tax advice. He's a 1031 QI.
Exactly.
I'm a commercial real estate professional. So CPAs certainly know a lot about this as well. So and everyone's situation is different. Of course, there are times when people are okay with paying the gains on a property or taking loss on a property. It might be appropriate. Just depends on the situation. So just wanted to throw that caveat out there. We mentioned earlier, I did in the intro, that the different time frames. So we established now that hey, you got to set this up prior to closing. When you know, so my example was $2 million purchase. You're selling it for 4 million. You're talking to hopefully a brokerage professional to dispose of the property, but also the 1031 intermediary because the proceeds will be paid to the QI in advance to go back to Aaron did make it clear they can pull it off at the last minute, but
Yeah,
best thing to do is do it in advance. So
that's
tell
right.
me, explain a little bit about the time frame, the time frames that are super important to adhere to, in addition to just being prepared prior to close.
Yeah, exactly. Yeah. So the exchange time frame itself is it starts again on the actual close date of the sale property, 180 days total. That's the time frame to actually complete their purchase or their purchases. Um, Now, day 45 of that is important. That's when they have to actually identify potential properties. And so if they haven't closed yet on the replacement property by day 45, they would turn in a list, usually up to 3 properties at any value, and then after day 45, they have to stick to something on that list. And it all has to be wrapped up by day 180 in total. And so that's where some do get tripped up because perhaps they sold a property at the end of the year. And this has happened. I think we're on number 7 or 8 as far as phone calls we receive. They sold a property at the end of the year thinking they're going to get it in on their tax year. Now they think they still have 180 days to buy something. And they call us, and of course, we have to break the bad news that, well, it was supposed to be set up before you closed. And unfortunately, there's nothing that we can do about it from the 1031 side to make that happen. Hopefully, they can find some write offs with their CPA or something else. And the other part on those timeframes is they are set in stone by the IRS, whether it's a Saturday, Sunday, or holiday. It doesn't make a difference to the IRS. There's no extension unless there's maybe a natural disaster. And so that's part of what we're doing as a QI as well. We're watching that date, giving reminders. And if it's going to fall on a Sunday, they're not getting 180, they're getting 178 days because they got to close by that Friday. So those time periods are very important to be aware of and to be planning for. And another reason to be planning, ahead, even before they sell, to be thinking of these things.
Right. So okay. So and let's just add to the story I'm telling here. So you're going to plan ahead. So you're not just going to plan ahead and contact and identify who will be your QI, but you're also going to hopefully maybe start thinking about what that replacement property, as it's called, is might be. And frankly, it could be multiple because you don't have to buy everything on your list. You just have to have a list by 45 days, if I
Right.
understood correctly.
Yes.
So you're working with a brokerage professional like Coldwell Banker Commercial and trying to find what would, and it doesn't have to be in the same state. It could, right? If I
Yep.
remember correct, it could be anywhere in the country. If you're selling a net lease retail, you can buy it industrial. It's okay. It doesn't have to be the exact same property. And there are some strategies if you have a little leftover money and so forth. We can maybe touch on that later.
Exactly.
So Pre-plan, identify the QI, hopefully start to think about where you're going to look for that replacement property. Have them identify because there's options there within 45 days. I think that was the date, 45 days. And that is not business days, as Aaron just said, that is just days, right? So
Correct.
just look at the calendar and it's 45 days. Doesn't matter if it's Christmas, New Year's, your birthday, whatever, it's 45 days. And then within 180 days, you actually have to have closed on that, right? Did I get that right? That's the time frame we're talking about.
That's exactly right. Yeah, you got it all correct. And that's good as far as the timeframes. I want to point out one thing on the 45-day. It scares some people, right? They get a little anxiety, and sometimes they think that's going to scare them away from doing a 1031. But again, it goes back to the planning. This is the only one of the few areas where the U.S. government gives us a gift, really. I mean, how many times the IRS going to say, "Oh, you owe me $250,000, but oh, you need to use it. Go ahead and just use it. Then you don't have to pay us yet." So with the 1031, we got to take advantage of the opportunity. Yes, there's some rules. The IRS is going to put some rules in, but just plan ahead. Be thinking about these strategies. At least give yourself the opportunity to try to take advantage of it. Um, and with the three property rule, so on that day 45, they can identify up to three at any value. If they go over three, it's capped at 200% of what they sold. Um, but it doesn't mean they can't write a ton of offers on replacement properties before that. Yeah, so that's one little, confusion that comes up is they think their property just sold. Now we're on day one. They want to put in an offer. How do I identify this? And I tell them, hey, just put in the offer. You can put in 10 different property offers right now. Doesn't count until actual day 45. That's when you need to turn in a list and make it finalized.
Right. So you can start the process. What you're saying is you can start that replacement property search earlier. So you can have a number of options. As you said, you can have 10, but only close on one. That's okay. But you want to start that earlier because I think probably more people than not don't realize how quickly 45 days goes. It's not very much time, really. It's just a month and a
Exactly.
half, right? It
Yep.
goes by super fast. And as you said, it's not business days. These are just days.
Right.
So it doesn't, as I said, no heating to a vacation that's planned or anything like that. It's 45 days. The clock starts and you're done.
Yep.
So super important there, but that's a good advice. Start early. A, identify the qualified intermediary. B, start looking for that replacement property. So when you're ready to close on your current sale, you're already, partway down the road, if you will.
That's exactly it. Yeah, yeah. You don't want to be caught flat-footed, and it's amazing. It still happens at times, but some will, they're closing on their sale, and as part of our consultation, we're just going to ask them kind of what their plans are. We want to make sure they're meeting the valuations and such. And there are some that are saying, "Oh, I haven't really thought about it yet, or haven't started looking yet." And yeah, so those are the ones that are going to be under the gun, perhaps, and maybe complain about the time frames. But usually, people are already thinking about it. We just like to double check and make sure they're on the right path.
Yeah. So why don't you just you started to elaborate on it right now, the role of the 10. So the qualified intermediary collects the funds, the proceeds from the sales. But tell me, describe for our listeners what other role is that QI playing for? I guess how do you differentiate 1031 specialists from other 1031 intermediaries? What are the services that you are providing for the benefit of that investor?
Yeah, absolutely. So it's a great question because when you boil it right down to the brass tacks, all the 1031 QIs, in a sense, are doing the same work. We have to set up the exchange paperwork, make sure that the closing agent has everything correct for closing. We have to hold the funds, and then we do it all in reverse, basically, for the replacement property. We have to make sure that closing agent has everything correct paperwork wise, and we send the funds. So all of that just sounds like, well, everybody's the same. Within that, of course, we know how real estate is. You got start getting into nuances, scenarios, challenges, and questions. And so we've created a whole customer service happiness part to where we don't just set up the exchange to where it's just cookie cutter assembly line process. Because we realize you can get in the middle of exchange and suddenly things don't go as planned on your properties, and you have a lot of questions. And so with our technology that we've set up, we're able to set up the whole process without friction. We're not going to, hold up a close by any means. Nobody has to worry about having their exchange ready, but then that frees us up to provide that customer service and ongoing consulting all the way throughout and during the exchange. If somebody needs to change paths or, something, a property fell out, what do I do? These kind of questions. Or now I'm doing a partial. What are some other options I can do? So that's all part of the that the service, the setup, the technology, the transparency we provide is just one flat fee and that's it. And it's a feedback guarantee. If somebody doesn't complete their exchange, we give it back. So again, we want to give every investor the opportunity to at least
Nice.
try to exchange. So if they're selling and they keep thinking, "Oh, I'm not sure," they're hesitating
Right.
to set it up. We tell them, "Hey, go ahead and set it up. We want to give you the chance. And if you don't identify by day 45, your funds are coming back to you, plus your fees coming back." So we provide those guarantees. The other part is the security of funds. Now we're going to be holding their funds. And where does that go? Is going to be their question. And so we really look at, of course, number one job we have is making sure their taxes are going to be deferred. But 1B or very close to the 1A is making sure those funds are in lockdown and aren't going anywhere. And so we've set up different processes. One of the main ones up front, besides the E&O and the bonding, which we have, is setting up its own separate bank account for every single exchange and going out of our way to set up a qualified escrow agreement. So which means nobody can unilaterally move those funds. And so with other accommodators, if they're not doing that automatically, they have to ask why. Because they could literally take, half of all the deposits and move those to another institution or where have you, chasing an interest rate that they can make money off. Whereas a qualified escrow agreement does not allow that. It takes us time and money to set it up. And then on the flip side, at the end, before we go to wire the funds out to the close on the replacement property, we've invested in technology that verifies. Besides doing the standard verifying of the wire instructions, we run it through the system again to let us know if there's any flags that could come up. So the internal, that's a very sensitive issue right now with fraud everywhere. So internal possible fraud, external fraud, we feel our process is the gold standard for taking that out of the equation. The exchanger, when they go to close, they know their funds aren't in something illiquid. They know that it's there in the same account and that it's going to show up to their replacement property on time.
Right, so it sounds like one of the distinguishing factors of you guys, you're very service-oriented, being a partner to that investor to make sure all of these various steps, I mean, you know them on the back of your hand because 'cause you've been doing this and this is your profession, but, the average investor, like myself, you're not gonna remember it, right? So you're
Right.
there to walk them through all the steps, make sure they don't have any missteps along the way, and then you also talked about just the security of funds, right? To make sure that they're sitting in a secure place, so there will be the funds when they are closing on that next property, those funds will be available. They've been in the safe vehicle to actually deliver to the buyer or to the potential buyer of the next property. So makes sense. Got it. Um, with the last year I can't remember now. It was mid-year, right? The big beautiful tax bill passed. I know periodically there is discussion about modifying or eliminating 1031, but I have to say for all the fear that exists in our industry about it, it still exists and it's still there. And as long as it's legal, right?
Right.
Who knows what the future will bring? But was there anything in that tax bill last year that changed anything about 1031s that people should think about? Or is it pretty just, neutral because it was it was not changed?
Correct. As far as the 1031 and the existence and the use of it itself, that part hasn't changed. I'd say in a way that the bill doubled down on real estate investment, confirming again that they'll allow exchanges of real property, not personal property like they used to years ago, but real property exchanges allowed. And what the bill brought back was 100% bonus depreciation. So that was being phased out from the last bill, and now it was reinstated completely at 100%. So what it's really telling me is that the current policy is doubling down on real estate investment. It can be used as an amazing tool to grow wealth and even offset perhaps other losses somebody might have on their taxes. And in fact, on the subject, we go to different conferences. I was at the NAR conference a couple months ago and talked with a group that is trying to take advantage of that current policy status and lobbying for new additional bills to expand 1031s, in fact, where they're trying to create it to make it, more accessible, make the timelines longer, just, make it easier for all investors. And so currently, as we're speaking, yes, 1031s are in full effect, and they are being used along with bonus depreciation as ways to really reduce taxes quite a bit.
Excellent. So the good news out of the tax bill is there's some additional enhancements. Again, as I mentioned earlier, consult your tax professional or your CPA to get advice because bonus depreciation is a particular strategy. And there's other kinds of tax strategies with real property, but key is the 1031 provision was untouched. It's still available to investors with those timelines that Aaron and I discussed earlier in our conversation. So wipe my brow, all good for this go round. I'm
Right, we're
sure,
good.
just given politics what they are, it'll be back on the table at some point.
It will.
But fortunately, our legislatures have been thoughtful about real property investors and what it does because that churn of investment does, stimulate development and other things. So hey, it's good for the real estate industry and it's good for private investment at least as long as it's still allowed. So that's fantastic. Let's see, what else can we talk about? Let's think, is there anything you see on the horizon in the future? I don't know, something to think the out any kind of outlook or trend in this space that you've seen investors considering. Anything come to mind?
Yeah, well, you kind of mentioned earlier DSTs or Delaware Statutory Trusts,
Yeah.
as far as a means
Yeah.
for
Good
yeah,
point.
to allow for passive income within 1031s. And that's been making a difference for those investors that perhaps have been landlords or handling, real estate management for a long time and were wanting out. And normally they'd be saying, hey, we're just going to cash out. And now, again, are they realizing the huge tax bill they're going to have? Well, how much better would it be to have a place you can put it and DST's been getting popular. We don't push or promote it, but it's just we're seeing about maybe 10% actually now of exchanges going into DSTs, whether it's a main investment or perhaps a second property when they weren't buying enough on their first property, or as a backup on that 45-day list when they're not feeling too good about the choices they have down on the list so far. Maybe add a DST as a last resort that they can still put their money somewhere within 180 days. But yeah, different passive income options is what we're seeing, whether it's that or triple net lease, even oil and gas. Just the investors don't usually realize that those are there, that they can combine them with other asset classes that they're already thinking about. And it makes a wonderful opportunity for them.
Excellent. So just to clear for our listeners here, DSTs or Delaware Statutory Trusts are a vehicle. I think of them most commonly, let's say, back in my example, $2 million. You paid for it, you're selling it for four, but your new exchange property is only 3.6 million. I'm going to make it up here. So now you have 400,000 left over. So as I understand it, you have the choice of potentially paying tax on that $400,000 gain, up to you, just personal situation. Or there are these vehicles that are in colloquial real estate called DSTs, where you can roll that excess funds and still avoid the tax consequence and get the 1031 advantage. And as Aaron said, if you outline 10 properties, your plans are fantastically clear prior to closing, but for some reason nothing works out, and you really want to avoid that consequence, there are these DSTs. In a sense, they're kind of I don't know, backup for the investment rollover. I don't know how else to call it.
Yeah. Yeah, that's
Is that fair? I
exactly.
don't want to get us probably a whole other podcast on
That
DSTs,
would
but
be. Yeah.
they kind of work hand in hand. I guess my point is they work hand in hand. You don't need to identify a property exactly for the amount, right? You can be a little bit under and use the DST, or you can pay tax on it. Or if your identified properties fall through, again, there's a vehicle to defer the tax on it. And then you mentioned it earlier, but what happens if that replacement property is, in my example, 4.1 million? So it's more than you're rolling over. Then what happens? Is there something to be cognizant of in that situation, Aaron?
No, in that so if you're gonna buy more than what you sold, you're good. As long as all the cash is rolling over at the same time, that's perfect. So as long as you're buying equal or greater value on the new replacement property, then you just deferred 100% of your tax and you are good to go.
Okay, gotcha. Yeah, so that's just that. So we have the time frames to keep in mind, when to start, when to identify, 45 days, close within 180.
Yes.
If your option is a little bit under your gain from the sale, you do have the option of DSTs as one option for the extra money, or as we just talked about, buy a property more than you have gained in the sale, and that's totally cool. Nothing wrong with that. Doesn't break any rules. You've basically rolled over the gain from the sale, and then
Yep.
you've added to it. So totally up to you,
That's
right?
exactly
Totally up
right.
to you.
Yeah.
That's
Multiple
fantastic.
options. Yep.
Um,
Absolutely.
yeah, there's a lot of options, and why there are intermediaries like 1031 specialists is simply because it's a lot for people to remember. And if you're not doing this every day, and things change, not to mention the security of where your money's held and that sort of thing, you want someone who can advise you. So your brokerage professional, your broker can help you negotiate the deal, identify the properties, but that broker is not an expert in exchanges. You need an expert advisor because to be successful in commercial real estate investing, frankly, you need a whole array of advisors. You need attorneys, you need tax advisors. All these people play a role for the successful commercial real estate investor.
Yep. That's exactly right. Yeah. We're just part of the
Cool.
team.
Anything else, Aaron, you want to? Yeah, exactly. Part of the team. Exactly. You do need a team. This is a team sport.
Yep.
Aaron, anything else that we didn't touch on that you want to hit on that maybe you see are mistakes that are made in the 1031
Oh,
process
yeah.
or things to be wary of or aware of?
Oh, yeah. There's so many mistakes being made, Dan. But there are definitely some top it's usually top misconceptions, that, folks come in with, that we're seeing all the time, the kind of the same themes that I'm talking about every day. But one is, again, talk about investors. The last couple of years, I've been seeing a lot more that are just saying they just want to cash out, they're kind of done. And so we've talked about that a little bit with the DSTs and options, but it really comes down to, for a lot of them too, just not being aware of the full tax hit that they're going to be facing. And so we always, break that down as to what the layers are. We can't break down for them personally, right? We're not giving tax advice, as we've been saying, but they have to understand the federal, the state, the possible net income, investment income, and the depreciation recapture that everybody forgets about. So it's making sure they understand the full tax hit. I do see some that will think they come in with the thinking perhaps that yes, we're going to exchange, but they're thinking it's all they're doing is exchanging the gain, and they're going to take out the tax basis. Like, well, this is the money I put as a down payment originally. I should be able to get that back. So we have to again go through that with several to help them understand. No, it all has to go. You have to keep it moving. We discussed not setting it up in time. That's just that's a real basic one, but yet gets missed so often. And then we've talked and alluded to the different property types, and the reason that so many get confused and have missed opportunities is because everybody likes to get on and Google 1031 exchange, capital gains, all this, and then they see this term called like kind exchange, and that confuses the heck out of everybody because they keep seeing this like kind, and it gets beat into our heads where yeah, we're going to think it means you have to have the exact same asset class. So somebody's selling a duplex, they think they got to buy another duplex, or they're selling a condo, they got to buy a condo. They're selling an industrial warehouse, they got to buy an industrial warehouse. And that is absolutely not right. It's just like kind is investment property for another investment property, whatever one of those property types, it doesn't matter at all. And it can be a mix and match, even vacant land. And so I bring that up because that gets missed a lot, whether you're going into or out of. I had a client sell their family farm property back in Illinois last year, and they turned around, it wasn't being used, no cash flow. They bought 3 different properties that are cash flowing. So these are just some of the misconceptions that I see get missed when things are being Googled and not quite understanding the whole sense of the nuances that are involved that we get to kind of help them set straight and make sure they're not making mistakes.
Excellent. Yeah. I don't know who came up with that term like kind, probably some attorney, right? But it is a little confusing because it could lead people to believe, as you said, multifamily to multifamily, industrial, industrial. But that is not the case. Like kind means investment property to investment property.
Yes.
That's going to say more generically. That could be self storage, it could be industrial, it could be office, as you said, it could be land. That whole array of investment, real property used for investment purposes. There's quite a big array. And then as we talked about the DST, that's another option. But again, I think we also just hit on have a team of advisors. Your 1031 intermediaries an advisor, your commercial brokerage professionals an advisor, your attorneys an advisor, your accountants an advisor, your lenders an advisor, right? All
Yes.
these people, and there's probably more that I'm missing, are important for a commercial real estate or even a hobbyist investor because these mistakes can be very costly, as we just talked about. You may think it's like, oh, whatever, it's a $500,000 gain on the sale. Well, that's, depending on your tax rate, that's a check you're going to have to write when you file your taxes next year. And gosh, who wants to do that? Nobody.
That's
Right.
exactly
And there
right.
are ways to do it. So don't take it. Yeah. And plan in advance. Right. And I think we also hit on it's just to be clear, this is not just for institutional investors, right? Yes, it's just institutional investors have all kinds of tricks in their bag, of course, as big investors might. But the hobbyist, the occasional investor, the small portfolio, all the types of people that invest in real estate, they absolutely can take advantage of this 1031
Yep.
provision of the tax code.
Yeah, that's
So
exactly right.
that's fantastic.
Yeah. Yep. Absolutely. Yeah. It hurts me so much just to see somebody paying unnecessary tax. And that's why I feel like every single deal should be an exchange. I know it's not going to be. There are reasons why somebody may not. But if at all possible, if they can, reduce that tax bill and keep that money working for them, that just makes us so happy.
Excellent. Yeah, as we said, talk to your advisor because there are reasons. It could be an estate or something that's got to be split up amongst heirs. There's all kinds of reasons that could happen that may make it to make sense to pay the gains and move on. But
Yep.
1031 is definitely an avenue. So again, I really appreciate your expertise today, Aaron.
Yep.
It's been fantastic. So why don't we say this? So if you're watching the video, you can see that Aaron's wearing a shirt that says Mr. 1031. That's his name. If you can't pronounce his last name, I won't spell it for you. You'll have to look on the podcast summary to see the spelling there. But be there as it may, where, Aaron, can they get a hold of you? First, you might want to specify the 1031 specialist website. And then for you in particular, since you're so knowledgeable, where can people get a hold of you if they want to talk to you about being an intermediary for them?
Yes, 1031specialist.com is our company website. And that's where will find Mr. 1031. That's the name of our AI that we have, that we built. And so right there
Oh,
on our website, if you have any questions 24/7 and you put it in there, you will get a very thorough answer that's based on all the tax regulations and all the court, private letter rulings and such. But that's Mr. 1031 is the AI bot. I am at Aaron, AARON, at 1031specialist.com. That's my email. I have a direct line, which is 760-509-1519. I take text and calls, and I do conference calls all the time. And I'm also on LinkedIn, trying to put up some informative videos and updates at times as well. So any of those sources, whichever is easiest, please feel free to reach out.
excellent, Aaron. Really appreciate that because as we just covered, there's a lot of nuance to it. And if you don't think about this for another 9 months, you are either going to have to listen to this podcast again, or you're going to have to watch a Mr. 1031. I love that name, Mr. 1031, your AI assistant, to learn and refresh your memory on the process, which of course may have changed by then. Who knows? But anyway, Aaron, you've been a fantastic guest. Let me just take away or summarize the key takeaways if I could. So first of all, I think it's clearly the 1031 is clearly one of the most powerful wealth building tools in commercial real estate or in real estate investing, right? Don't overlook it. Take it seriously. It's great to have a gain from a sale, but it's even better to have a gain that you can roll into future investments and avoid a tax liability. Legislation from last year did not impact the 1031. It's still around. There are some other things that people can take advantage of, including accelerated depreciation and whatnot. Again, it's a subject for another podcast. Key takeaway, timing is everything, right? 45 days, 180 days. Start early. Identify that intermediary. Start identifying those replacement properties. That'll avoid the scramble, and that'll make the process that much easier. And if you have a great intermediary, they will also obviously help you through the process. Let's see what else. Investors have more in replacement options than ever. We talked about fractionals or DSDs. But again, there's lots of nuances to the process that you can learn about. So listen to other podcasts. But Aaron, I want to thank you for your being our guest today on the CRE with CBC Worldwide podcast. Thanks so much for being here.
Thank you so much. It was my pleasure being here. I appreciate it, Dan.
All right. And if you've enjoyed this podcast and this episode in particular, follow CRE with CBC Worldwide on Apple, Spotify, or wherever you get your podcast. Like, recommend, all those comments, all those things. We'd love to have you listening to this episode as well as others. We have a series of episodes. This is just one that focuses on topics of the commercial real estate industry, but listen and follow for more. For more insights and resources, you can also visit us at cbcworldwide.com. Thanks so much for listening, and thank you to Aaron for being our guest. Everybody have a great day.